Okay, so by my watch, that's 9:32. So let's get started. So good morning, everyone, and welcome to the 9th in our series of weekly webinars. I'm Maxine Reid-Roberts, and I am your chair for today. So as the country is slowly but surely easing out of lockdown, we continue our series of webinars by sharing our insights with you as to what we're seeing in the current market. During the webinar today, our experts will discuss the notion of buying a business out of administration and how businesses can take advantage of post-lockdown opportunities. So there's a little bit of work for you guys to do this morning. So on your screen now, you should see a live poll. We've created the poll to gain a bit of an insight into your understanding of buying a business out of administration and also your thoughts on how the businesses will recover. So question 1, are you or your clients thinking of buying a business out of administration? Question 2, are you confident in undertaking an administration process, as well as understanding the risks and opportunities compared to that of a solvent acquisition? Question 3, now that the rules around lockdown are relaxing, how quickly do you think businesses generally will get back to a robust level of trading? And the final question is, do you think that you or your clients who have had historically successful businesses may now end up being sold as a result of the effects brought on by coronavirus, COVID-19? So we'll share the results of the poll with you at the end of the webinar. But if you haven't had a chance to complete it, then please feel free to do so. The Q&A function is also available for you this morning to submit your questions in real time, and we will try our best to answer them as we go through. And some of you have also submitted questions in advance of today, which we will aim to answer at the end. Before we get started, thank you in advance for any technical glitches if we go through them. If you could just bear with us and be patient, that would be great. And now let me introduce you to our speakers for today. So first off, we have Simon Bonney, a licensed insolvency practitioner and partner in our restructuring and insolvency team. With his legal background and technical knowledge, he focuses on providing practical advice and delivering solutions to companies and individuals in financial distress. Simon regularly undertakes appointments involving cross-border investigations and litigation. And joining Simon today, we have the Ian Barton, a partner in our corporate finance team. Ian is a corporate finance specialist and has a specialist experience in logistics, software, and private equity. Ian leads the corporate finance team along with Mark Lucas, and his work over the last 20 years has focused on advising shareholders on merger and acquisition plans, sourcing funding, and planning shareholder restructuring. Lastly, I'm Maxine. I'm also a partner in our restructuring and insolvency team, but today I'm just your chair. So let's get started. So Ian, you're going to talk us through a recent case you worked on with Simon, in which a private equity-backed business acquired assets from an IT services business entering administration. Can you talk to us about what the original issue was and how you worked with Simon to achieve a positive outcome for those that were involved?
Yeah, thanks, Maxine. Yeah, so this was a deal that Simon and I worked on a few weeks ago, and essentially it was a private equity-backed IT services business looking to grow its market share once it became aware of a competitor business that was entering distress. And they spent a fair bit of time prior to the business actually entering administration trying to negotiate a solvent acquisition. They were essentially interested in roughly half of the business and not the other half of it, due to the nature of the services that the target business undertook. And they, like I say, they spent some time trying to negotiate a deal, weren't able to get there, and ultimately the shareholders decided that they would have to file a notice of intention to appoint. And that kicked off a sort of a 10 working day timescale to try and structure a deal. And it was at that point that the client got in touch with Simon and I and said, look, we know how to buy businesses in solvent situations. We're quite skilled in that. We've done our own deal. We've got all the private equity backing from our fellow shareholder. But what we don't have is the skill set and the knowledge of the intricacies of how to negotiate our way through buying from an administrator. So Simon and I came together to essentially, provide a joint team where I was helping them with that acquisition and the approach and the conversations with the administrator. and Simon was providing that insight as to how an administrator will view any offer that is made, what works for the administrator, what type of offer is going to be more capable of acceptance or rejection, and working through that tactical approach. So the key to this process, I think, and the takeaway I would sort of want you to understand from this, is that the process is pretty dynamic, much more dynamic than a solvent acquisition might make, because very rarely do you start off with a set outcome and a set plan and end up in exactly that place by the end of it. You've got to be quite nimble, and you've got to respond to the challenges that come through the process. So within this, they obviously started from a solvent position, looking to acquire the business and assets. That then changed to sort of trying to acquire the contracts and the debtors associated with those customers, but that brought out 2P issues for them. That then migrated into an offer around, could we do a collect out deal on the debtors and the IP, and negotiate with the customers direct. And then finally, sort of resolved as an IP acquisition, largely because of the risk of 2P of the employees, both from the part of the business that they were interested in acquiring, but more critically from the part of the business that they weren't looking to acquire. And they were very keen in this process, not just to make sure they bought what they wanted, but that they didn't inherit the things that they didn't want, and those liabilities were left behind. So in essence, this process was about making several offers, working with the administrator, and really demonstrating to the administrator that our client was well advised, understood the process, could react, and could deliver. And the ultimate outcome, therefore, was that they did get the deal done, and they're now integrating that customer base into their own network.
Excellent, thank you. So moving on to the main part of our webinar, Simon, I don't know if you had anything to add, sorry.
No, Ian, as usual, explained it all perfectly. It was an interesting case, and also it was I think it was quite insightful for both Ian and I to work with each other on that type of specific scenario. We're about to do a case study on tech sector, but as I said to Ian very early on, I didn't envy the position of the administrator in that case, the putative administrator, because of the nature of the assets and trying to keep a business like that together while you're going through a pre-pack process. So understanding, it's always helpful to understand what the likely mindset of the vendor is going to be in an administration scenario, because it informs how you go about engaging and also where you might pitch your offer. And with that, it's probably helpful if we move on to the first case study. Good morning, everybody. What we thought we'd do is pick through 3 different case studies and just talk around some of the issues that will arise in relation to specific assets, specific liabilities, and try and deal with 3 different sectors in terms of different aspects and challenges that might arise. The first one, it does to some extent follow on from the case study that Ian was talking about, and this is based on what we were dealing with. This is a balance sheet, as I said to him before, that fills me with something of horror, purely because if I was to inherit this as a potential case that I was asked to advise on, there is immediately a challenge in terms of the tangible assets on the balance sheet versus the intangibles, and how to preserve value while going through a process. So if we pick through this balance sheet, probably the first item on the agenda is the intellectual property, the goodwill, which has a large book value on the balance sheet, but there's a significant question mark as to what value we're going to be able to achieve for that in a sales process. And then really onto the trade debtors. And given the fact that this is a people business, and we're going to face a huge challenge if we were selling it in trying to keep those people together whilst we get a sale away, the trade debtor side and what we do with the debtors is going to be very important. It's a large number. In theory, it's a real number, but actually there's going to be a number of factors that a purchaser would want to understand in relation to how to pick through what the real value is there. And Ian can talk a bit more to that.
Yeah, so I mean, the issue here is around who controls the debtor at the end of the day. So at the start, once you go into administration, that's the administrator. As Simon has just said, looking at that balance sheet, that's the one real asset that he could actually get some value for. So it's the one asset that he's going to focus his attention on and try and maximise the outcome from. Clearly, from a purchaser's perspective, that's our lens into the relationship with the customer that we're hoping to integrate into our own business over time. So the balance there is that we clearly don't want the administrator coming in with his hobnail boots and damaging that relationship through collection procedures. But equally, we would be asked therefore to pay a fair value to acquire those rights up front. So there's a real balance there as to whether you acquire the debtors or you agree a collect out and pass back a portion of that value back to the administrator over a period of time. One of the key things, though, is what do those trade debtors represent? And in a software business, a large portion of that might be forward contracts, so things where people are paying in advance, perhaps 12 months in advance, and I'll just come back to that in a second. But the other aspect might be for work that's already been done and not yet paid for, and ultimately, or it might be for work in progress on a large scale project that somebody needs to finish off. So there are an enormous number of challenges there as a purchaser to say, well, if I take on that customer, am I going to be expected to do something at a discount to retain them and represent the fact that I might not collect out all of those trade debtors? You'll notice that down in the unsecured claims piece, sat within that 730,000, there's going to be a large portion of deferred income, i.e. A customer has paid in advance for a service that's going to go beyond the 31st of March off this balance sheet. But it's very unlikely that service is going to be provided by the existing company or the administrator. And so if we take on that customer, what's the expectation of us having to deliver that service, potentially where the customer has already paid for a year in advance of that? And I think one of the important things as a purchaser there is one to go into that negotiation and understand what you may or may not be prepared to do for that customer. But equally, that might have a knock-on impact on your future working capital, whereby that customer might turn around and say, well, I'm not going to pay for 12 months in advance again. I might pay quarterly in advance. And that's going to change the dynamic of your working capital position, probably as an owner going into the future.
I think, and with that, I mean, it's always important to remember that as I think actually an attendee on this webinar always reminds me, we are the kind of the A&E who arrive at the scene of the car crash. And so on day one of trying to figure out what we're going to do with the business and whether we can sell it, we are playing catch up straight away. And actually what we found in the case that Ian and I did was we were asking questions that the administrators didn't yet know the answer to. And from my point of view, that wasn't remarkable whatsoever, because I fully empathise with the position they found themselves in trying to deal with the sales process. But those things such as trade debtors, you're always going to have to bear in mind that you're only ever going to get a certain level of information. The DD is simply not going to be as detailed. And whilst I would be in the background busy desperately trying to get together as much information as I possibly can to understand what it is I'm selling, I'm going to be guarded about disclosing too much information to vendors, albeit they have to be treated equally. Another point that comes up on this balance sheet is our investment side, our subsidiary, and the fact that obviously we need to approach it from the point of view that each entity is separate, and therefore no assumptions can be made as to what's going to happen. Here, our investment is 100% shareholding in a subsidiary, which seems to have a similar business. A question for a seller is immediately going to be, A, is that attractive as an equity purchase? Can they buy the shares for a nominal amount? What does the balance sheet look like? And actually, are the administrators, the putative administrators, planning on putting that through a process itself, or what are they planning on doing with it? Because sometimes these things get slightly left behind and they become afterthoughts that are kind of scrabbled around to deal with later down the line. So it's always worth understanding any shareholdings that a business that is up for sale in an administration scenario has, and understanding what value lies there, but also obviously to what extent that that value has business interruption consequences. You know, if you've got 20 key customers of this business, but 3 of them happen to be with the subsidiary, and you don't make sure that's mopped up properly, then it brings risks. The other part of this balance sheet that probably stands out or certainly from the notes, is the employee side. And it was a big feature of the work that Ian and I did on our recent case, that employees were significant in terms of potential TUPE liabilities, and trying to figure out how to mitigate those liabilities, but also importantly, trying to figure out pricing the risk of them in terms of dealing with the offer. And I mean, it would be interesting to hear Ian's views on this, but what it became very clear for me, sitting on the other side from what I usually do, is that our client was very knowledgeable, understood a buying process, was not interested in a huge legal debate about what TUPE was or when it occurred. They just wanted to understand what the risk was, straight answers to straight questions, and how to deal with that as quickly as possible.
Yeah, I mean, I think that's generally a dynamic between the difference between solvent acquisitions and one out of administration. That you know, in the world of corporate finance, you know, conversations I had, negotiations I had, they're often drawn out. You know, obviously everybody's trying to feel around where an opportunity might sit. Within an administration situation, the timescales are compressed, the information is limited, and therefore the conversations are much more direct. And you know, the one thing that was noticeable for me was that you could ask very direct questions of the administrator. You would often get straight answers where they have those straight answers, but equally an honest answer to say, I just don't know the answer to that, you're going to have to take a view. And as a result, the client had to take a view on some of those things. And as Simon said, they weren't much interested in you know, the legal elements and what happens in these scenarios. And what they were really interested in is what's the pound note risk on me here, if I undertake the transaction in this way.
Yeah.
So
sorry. Just to close on this, we've had a question which I'll deal with now from Neil. With regards to debtors, would the administrator prefer to collect trade debtors, or if the business is sold, would they prefer the new code to collect them for a commission? It is entirely dependent on what we believe we can achieve the best value for. When you go into these processes, I suppose from my point of view, I have an expectation of what a purchaser might want, and actually the likelihood is with a business like this, as Ian says, that those trade debtors are one of your key assets because they're also your customers, and so the likelihood is that a new co is going to be the one that wants to deal with them. Now the question then becomes one of value. If that new co is asking for an extortionate commission rate in order to collect out those debts, I'm less likely to be attracted to that. But naturally, it's the best option for me if the commission is reasonable, because if they're providing ongoing services, it's the best opportunity for that customer to then not argue about paying their previous bills. So the answer is, and Ian and I did discuss this when we were doing our case, that there is no preconceived idea on this. Especially, I mean, obviously it's a slightly different way. You've got an invoice discount restructuring place. But when you've just got the book debts there and available, and an administrator is going to be open to all options as long as they're sensible and as long as she believes that they provide what is likely to be a good outcome for the collection of those debtors.
Yeah, I mean, just picking up on that point, you know, we didn't end up agreeing a deal on the collect out, principally because actually the administrator wasn't really able to identify within the trade debtor balance those elements that related to future services under a 12-month support contract, which we said, I just think the chances of us collecting that on your behalf and then providing the service is going to be close. You know, we're going to go and have that negotiation with those customers and strike a new deal with them. So the administrator took the view that they had a better chance of collecting more value than in the more than generous offer that we made to him to do that collect out. Just one final point that I would just flag on this in terms of being an acquirer and thinking about how this business goes forward is around the supply chain. And you know, and I've worked with 2 or 3 businesses over the last 2 or 3 months in this sort of IT space. And I think one thing that's important to bear in mind is that if you are supplying kit as part of your services, a lot of that kit actually does come from the Far East and certainly from overseas. And so you've got to be really confident that those supply chains are going to be able to continue to flow. How, you know, you might have to pay on shortened time frames than you have historically in the past. And there's probably, and certainly I found, certainly through February, so before lockdown, but when some of the Far Eastern countries were in the middle of their lockdown, actually sourcing kits was quite a challenge. Anybody who tried to buy a laptop, I think in sort of early April would have seen the same issues because there was just, the kit wasn't available. And so, you know, that drove negotiations, prices went up, you had to pay in much shorter time frames to be able to secure those assets. So as a buyer, make sure that your supply chain is secure, and we'll pick that up, I think, on one of the other scenarios around payments to creditors, Simon. Okay.
Thank you both. So just a quick reminder, the poll is still live. So for those of you who might have joined a little bit later, there's a poll happening. It's 4 questions. We'd love to get your input into that. And the poll will close shortly after this scenario. So next we're going to move to the food and beverage sector. And do you want to give us your input as to what that might look like in an administration scenario?
Yes, thanks, Max. I find sometimes that I'm a bit of an insolvency geek. It kind of pains me to say that, but it's true. And actually, this I think is a fascinating sector at the moment for a number of bad reasons, in the sense of the kind of extremely punitive effects that COVID-19 has had on the hospitality and leisure industry. But actually, the challenges that it brings in trying to restructure a business in this sector, and the differences in approach that we have to take in order to try and achieve the best outcome in a situation where actually it's extremely difficult for a purchaser to understand what it is they're buying in this environment and what it is they're likely to get. So it won't surprise anyone to know that one of the sectors that we are advising a lot at the moment is food and business, food and beverage, and this example is probably relatively typical. Going down the balance sheet here, like the tech business, it's not a asset-heavy balance sheet, and that's not remotely surprising. It is a balance sheet based on infrastructure, based on intangibles, and an ability to generate revenue from an operation spread across, in this case, 25 sites plus a head office. So the first thing that you can't escape is a debate about leases and what you do with those. And I'm sure there's a number of people on this webinar who already know, but for those who don't, what would normally happen is, in an administration scenario, is that where you have a lease and a purchaser wants to take the benefit of that lease, or at least the benefit of an opportunity to negotiate with a landlord and occupy those premises, then we as administrator grant a license which provides them with security of tenure whilst they continue to negotiate. But the quid pro quo for that is that they have to comply with the license obligations, which is a bare minimum would be meeting the ongoing rent liabilities. Now, this puts us in an invidious position in this environment, because we don't have the same ability as a normal trading business to simply say, do you know what, we're not going to pay the rent and we hope to sort it out with you later, Mr. Landlord. I'm not going to take that risk, because ultimately that ongoing rent sits as an expense of the administration, which has to be met from the first realizations. So that the conversation changes. And actually, I think now I would put leases into three categories. The first is the rock star leases that a purchaser wants under almost any circumstances, and therefore is likely possibly to want that license granted to them, and is willing to pay the rent for a short period of time in order to secure the premises and at least have the ability to negotiate with the landlord whilst they continue operating. The second bracket is a more fluid one, and is probably more the middle ground of what's likely to happen over the coming months. And that is one where either landlords are engaged with prior to administration and they are asked to provide a rent-free period to the administrators whilst the purchaser negotiates a new lease or a lease assignment on alternative terms. Or if that can't happen, no license is granted, and on the assumption that the premises aren't trading and haven't yet opened after lockdown, then a purchaser is going to be in a position where they can go and have a negotiation with the landlord whilst no one is technically occupying the premises, and therefore rent doesn't fall as an expense. The third category is one simply where the leases are left by the wayside, and they are a kind of opportunity for a purchaser if they can get a deal to take on that lease, but if they can't, they're willing to walk away from it pretty quickly. So leases have become a very hot topic, and Ian, I think probably we've both found that for a lot of businesses, obviously with the rent quarter just having gone, they're a serious problem for most businesses.
Yeah, I mean, there was a stat out yesterday I saw from Moody's that said, you know, of the June rent roll, 50% had not been paid. You know, you might look at the other way around on that and say, you know, that's quite good that 50% was paid. You know, but there are clearly plenty of businesses that are still successfully trading and carrying on as normally as they can. But clearly the impact on rent rolls was something that was being felt, you know, before the lockdown began, and was a feature of lots of conversations between high street, you know, rental sites and their commercial landlords around, you know, reductions and future payment requirements and the like on that. And that's going to have ultimately a long-term hit on, you know, the owners of that commercial property. You know, those landlords who have, you know, built their portfolios on essentially an ever-increasing rent roll and an ever-increasing valuation metric. You know, there's going to be a substantial correction within that, and you know, the impact of you know, the pandemic as we've seen it, whilst I guess some people might consider that to be a bit of a black swan type event on asset pricing, you know, the truth is that it was you know, a known unknown, in the sense that it was never really priced into those metrics in the past, and will probably be overpriced in the future, certainly for the next 3 to 5 years, I would expect. And that's going to impact valuations, and it's therefore going to impact the covenants that those landlords have with their debt providers. And you know, there are huge challenges coming down the line with those debt stacks, which these property portfolios have been built up around. So you know, this is, you know, the impact of one chain of food shops negotiating their lease position That is going on in thousands and thousands of retail and casual dining restaurants, both before lockdown and now in this situation too. And that impact is going to get felt widely within the commercial property market.
And I think when you look down this balance sheet, you've got £1.3 million worth of assets on there, but actually we operate very much in a world where the first thing we do when we look at a balance sheet is take a red pen to it and say, okay, we've got a book value, but what's our realisable value in this? Before even we're debating it with agents. And actually you look down this balance sheet and in reality, most of these assets are not existent in this scenario. You're not going to recover leasehold premiums. You're not going to recover rent deposits. You're unlikely to recover much in the way of prepayments. There's a lot of challenges there. So really what you're trying to figure out in going into an advisory piece on restructuring a business like this is what actually are you selling and what is the nature of a purchaser? And I think probably one of the answers here is that you need someone with relatively deep pockets who can maintain an infrastructure if they take that on, but also who is playing a long game. Because this is a sector in which things aren't going to get back to any form of normality for a very long time, and it is absolutely a sector where we're advising people who've had historical problems, but we're also advising people who've made lots of money and have been very successful and have now seen their business just fall off a cliff, and it's a pretty difficult thing to get your head around, but trying to understand where the real value lies in a balance sheet like this is probably in to some extent things like store equipment, to some extent in a bit of stock potentially, and probably Ian, the IP side, the infrastructure side.
Yeah, I mean, the smallest number on that balance sheet is probably the one that potentially has got the greatest value. That the brand itself, what it's built up to mean over a period of time, the quality of that across, in this example, 25 outlets. But the opportunity there is potentially for someone to say, well, I'm going to cut back from the 25 to a much smaller number. Look at those sites that I think I can get profitable. Huge debates in this market around what the 1 meter rule potentially will mean. It's clearly a benefit, but there are lots of these sites who are relatively small in terms of their floor sizes, and 1 meter will still mean very significantly constrained volumes that they can put through their sites. But the value of the brand, potentially to mothball it for a short period of time and then bring it back when footfall starts to return into the markets that this outlet is operating in, is probably the greatest opportunity for someone to take it forward.
And the last thing probably I'd say on that is just looking down at the liabilities side. You'll note there the group debt of £1 million. One of the features I think for purchasers is always to understand, well, A, why the restructuring is occurring. Is it a specific event? Is it just a business that's traded poorly for a period of time? And that will be evidenced by the management accounts, the annual accounts filed, but also actually, if you are having a restructuring for a specific event, who are you competing against? Have you got a group co here that wants to buy back its assets and has £1 million worth of power to do that in terms of liabilities, which it could put towards a credit bid, albeit obviously it would only account for a certain amount of credit in terms of the purchase power. But it's always worth trying to understand who it is that you're bidding against, to the extent you can find out from an administrator and an agent, and understand whether actually there is, for example, a management bid coming out of a purchase process.
Thank you both. So in this scenario where you've got the business that's got multiple sites and the purchaser's only actually interested in taking some of the sites, guessing that they can have that negotiation with the administrator. But then do you think that rent-free periods are going to be a thing coming through now that might be more popular for for landlords to be giving given COVID?
I think what we're seeing a lot of in the market is probably not so much rent-free periods per se, but rent-free periods by proxy, in the sense that leases are converting in some circumstances to turnover rents. And obviously, when you've got a business that shut its 25 shops, it's got no turnover, and so it's not payable. I think that there is landlords want some form of certainty, and I understand recently that there's quite a few pushing for kind of guaranteed rent, probably moving into the first or second quarter of 2021, wanting to make sure they've got a minimum level of income regardless of turnover at that point. But a balance has got to be found on this, because in reality, one of the biggest problems we have at the moment, one of the biggest problems business owners have, is forecasting, trying to figure out what their business will look like in 3, 6, 9, 12 months. And if you look at an economy like London, especially, I don't believe that there will be any sense of normality, any sense whatsoever, until at least September. And then the question will become, and I will use the phrase, what is the new normal? If Ian and I are only going into the office 2 or 3 days a week, how much of an impact does that have on the F&B sector in London? How many less people are there going out and eating at restaurants on a daily basis? None of these things yet are known quantities. So I think really with leases, it just comes down to pure commerciality, trying to strike sensible deals with landlords. I'm not sure rent-free is necessarily the answer as a kind of starting point, but clearly for us, in terms of granting licenses, if we're not in rent-free periods, then a purchaser has to pay.
I'm not quite sure whether you and me, the restaurant consumption that we had pre-lockdown will move the market, Simon, whether we go in for 2 or 3 days a week, but we'll certainly give it a right good go.
I think wine bars might stand a better chance. Okay, so now we're going to move on to look at what an administration in the manufacturing sector looks like.
Right, okay, so this one obviously is a bit different. First thing is obviously we've got a balance sheet which is much more tangible in nature. We have freehold property, we have plant and machinery of various different types, and therefore a little bit more of a known quantity in terms of what you're selling. Obviously, one of the large impacts in terms of this sector and generally is what's likely to happen to valuations in terms of assets over the next 3, 6, 9, 12 months, and whether there is going to ultimately be a flood on the market which depresses second-hand values and changes the nature of an ability to realise decent percentages for the sale of assets. But that I suppose will come out in the future. If you look at a manufacturing business here, first thing that you come across that is kind of interesting is the freehold property, and Ian, you can talk us through that a little bit more.
Well, yeah, I mean, the challenge is, for typically a shed here, I guess, and a manufacturing site that has got lots of plant and equipment in it, and is really used for that purpose and has been used for that purpose for some time. What uses could that factory be put to under other circumstances, and therefore what's the valuation metric that a valuer will use, and ultimately what is the price that a purchaser might pay to take control of that. I'm working on a transaction at the moment, which has got freehold property within it. We're looking at structuring a deal that includes the acquisition of that property. We've gone out and taken a professional valuation on it, and the valuation range is quite large. The valuation range was between 1.1 and 1.5 million, and far be it from me to to my fellow property professionals that might be on this webinar and listening in, but I probably could have had a stab at a valuation range of that sort of size, and that's not a criticism of that property valuer. That's just the way it is. There is very little tangible evidence for them to lock onto as to what that value might be. So from a purchaser's point of view, you're going to use that valuation metric that you've received, and then you're going to structure your deal around it as well. But of course, I guess within that, there's going to be quite a lot of plant and machinery that's sat in there, probably large bits of kit, and whether you can use those for existing use, whether you need all of that kit, what the relationship is with the lessee, the lessor on those pieces of kit. Simon.
Yeah, I mean the HP side is an interesting one. When you're in a restructuring process, it's a combination of a challenge and an opportunity at the same time, because for example, I dealt with a business where there was huge liabilities in relation to leased assets leased assets on fit out. But actually, in reality, the day it went into a process, the resale value, the recovery value was minimal. And so actually, if you're going to go into a process and buy those kinds of assets, then your starting point has to be their second-hand value, and we're working your way up from there. And actually, you get to this point of what's the business interruption value worth to you, and therefore what's it worth to pay for those type of assets, and what's it worth, especially in an environment like this, for an HP or lease company not to have to come and collect those assets along with all the other assets they're undoubtedly having to pick up as time goes on. Obviously, we have a large trade debtor balance here again. This is one that I'm likely to be much more bullish on. The likelihood is I'm dealing in the main with finished goods delivered, and I'm comfortable in the concept that assuming that the reason this business hasn't fallen over is that it was terrible at doing what it did, that actually most of those book debts are going to be collectible. So again, we come back to the same position of be creative. If you want to take on debtors, if you want to take on some of the debtors, if you want to do that for strategic purposes, or because you think you can earn money from it through commissions, then it's always worth having that discussion with administrators and making an offer. From my point of view, obviously where I believe that I've got much more capability of collecting in the historical debt, then I'm going to be more bullish on what commission I'm willing to pay, or what level I'm willing to sell those debts for wholesale. Stock. Ian, do you want to take ROT on stock?
Yeah, stock. There's going to be sort of three main elements of it. The raw materials, what's in WIP at any one point in time and still needs to be finished off to turn into a saleable asset, and then the finished goods stock itself. So, from a manufacturing perspective, and I've been talking to a business that deals in homeware and sells into the large retail multiples. Their concern is that the retail multiples have not been selling, so they've not been putting in orders. They've got stock already in the warehouse. How quickly will they work through that? And at what point, from a manufacturing business, will they get back to a normal level of production once they've worked through all of that finished goods stock that they have built up already for themselves? So there's a real judgment call there, based on how retailers come back to the market, and how how footfall into those retail outlets, and people's propensity to spend money, particularly if you're a manufacturer of a high value item that may well be challenged, because people are not going to go out and start spending big over the next 3 to 6 months until they've got a greater visibility on how the economy generally is going to play out for them personally.
So just Neil has raised another question in relation to the real value of the stock. I hope it's been answered to an extent. ROT is an issue. In terms of DD, all you can do is try and get as much information as you possibly can on what ROT is likely to exist, and price accordingly. We will obviously have our own view on that, and we will be respectful of people making lower offers because of ROT as a risk, but it's always a buyer beware issue. Sorry, go on.
Picking on that stock point. I'm talking with somebody at the moment who is looking at a business where there is quite a lot of finished goods stock, And he's saying, well, the price that he's going to pay, and I think this is probably a key point from an administrator's point of view, that you're going to accept the offer that is £1 better than the next best offer. And it's about, how much you get on at completion and how much you might get through any profit share that there might be on the sale of that stock over time. But as you were just saying there, the value of that stock is probably relatively low. And so, from his perspective, he's making a very low offer on that stock with a view that he can afford to sit on that stock potentially for 3 or 4 years. It's not, it's not degradable or anything like that. It's spare parts into big engineering businesses. And so he's confident that he can sell that over a course of 5 years. But that 5-year period is probably way, way, way too long for an administrator to take into account what value that might be. So we're having that conversation about trying to find a balance that makes it a compelling offer for the administrator around the time frame of receiving that money.
Yeah, and just to pick up a couple of final points on this scenario, and I suppose just to kind of draw people's attention to where our powers start and finish. You'll notice in the notes on this one that we have a couple of key issues. We've got key suppliers who management considers to be crucial to the business going forwards, and also one of the employees who's recognised as an industry leader in their field. Now, those types of issues, it's not in my gift to deal with to a large extent. They are issues for a purchaser in terms of how they try and navigate their way through those, but they're not something that can be priced in the same way as the purchase of the asset. So, for example, if on the critical business side, if that 748,000 that sits on our balance sheet, if we believe $500,000 of that absolutely has to be paid by any purchaser, then it doesn't work for them to say, well, we would have paid £1 million, we're going to deduct $500,000, and therefore this is our offer. Because actually, I'm not going to take into account that full deduction when I'm dealing with the offer. And indeed, someone can't say to me, actually, we're willing to pay £1 million, but on condition that you use £500,000 to pay off those specific creditors. So they can be debated in conversation, and obviously, each purchaser is going to face the same difficulties, and therefore, hopefully, pricing will go down accordingly in a sensible way. But you can't simply take into account that in terms of pure value when you're dealing with the sale of a business. Equally, when you're dealing with the employees, all I can really do is give you the opportunity to try and take on employees. I can't engage with you in the same way and say, well, I'm going to sell you a business, and at the same time, I'm going to guarantee that Mr. Bloggs joins you as an employee and will work for you for the next 3 years. It is entirely up to Mr. Bloggs what he chooses to do if the business goes through an event such as an administration. So those things need to be thought about beforehand. And if conversations need to occur to try and do sweetheart deals to take people on, then that's entirely separate to a purchase of the business. And hopefully those things dovetail together.
I think that's the key, really. I mean, for me, from a purchase point of view, this situation is all about your future working capital. If you are going to have to structure in those payments to those creditors to keep the supply going, at the same time that you are reopening the factory and furloughs coming to an end, and so you've got your cost basis coming back online, at the same time that potentially your stock turn is not quite as quick as you would need it to be on a normal level, because your ultimate retailer is having a slow start. Chances are that your debtors will pay you more slowly because they'll be challenged as well. So very quickly there are pressures in all the same directions that are going to expand your working capital needs. So for me, as Simon said, there's a price to be paid to the administrator to get the assets or the business or whatever you're looking to acquire in this scenario. But actually, the bigger piece of your funding requirement is likely to be your working capital, and building, really robust cash flow forecasts and being able to monitor and understand where the risks are is the key for a buyer in this scenario.
Thank you. We've had two questions come in, one from David. So going back to the food example, are you finding that landlords are being more realistic and engaging constructively given their perhaps belated recognition of the need to compromise?
I think the answer to that is yes. I think the problem that everybody faces is kind of loose agreement versus certainty. Wrongful trading has been suspended. Directors are in a highly unattractive position, especially in an environment such as F&B. And unless a landlord is willing to sign a dotted line and commit to a compromise, then the headline liability under the lease continues to accrue. So I think landlords absolutely recognise there is a problem, and probably leases are not going to look the same going forwards. As a global piece than as they do now. Turnover, I think, is going to become much more important, and price and expectations are going to have to change. But I do think landlords are being more constructive. It's just this difference between being constructive and actually agreeing something that a director can hang their hat on going forwards.
Thank you. And sorry, the second question. So I'm assuming an administrator will consider some cash on completion plus a deferred element.
Yeah, it's a miracle of this webinar. It perhaps speaks to both your and Ian's ability to control me that I've gone 51 minutes without saying cash is king, but cash is king, and the answer is that an administrator will look at and consider any offer, but the key aspects are, first of all, day one consideration is absolutely important. And following on from that, certainty of consideration going forwards is important. So if I'm offered £300,000 for assets on day one, or £200,000 plus a percentage of turnover, which might equate to 400,000, the chances are I'm going to take the 300,000 because I've got certainty. And actually, the likelihood is, and Ian knows this much better than I do, that you look at day one consideration, then you look at a conditional consideration. I'm sure Ian spends his life saying, you know, to a vendor, you look at day one as the money you're going to get, and the rest is upsides that hopefully you might see some of. So it's always worth having those conversations. Deferred consideration is absolutely not off the agenda, but day one consideration and certainty is very important in getting a successful process done.
Yeah, and just referencing that certainty point, you know, you might, if you have to go and raise funding, then, you know, if you have cash available to do that deal, so in taking Simon's scenario, if you can offer 200,000 and you've got that money and you could literally sign the deal tomorrow and pass the check across, you know, that may be more compelling than saying, well, I could pay you more, but I'm going to have to go out and find the funding. At that point, your offer has diminished in its attractiveness to the administrator. But I guess what I would say is have that conversation. You know, the administrator is not going to be shy in telling you exactly what they think, and you know, that will give you the guidance as to whether, you know, you do need to go and find, you know, more funding to increase your upfront offer.
Yeah, and just on that, I mean, Ian and I discussed this when we were preparing for this presentation. I know we actually prepared for this. Can you believe it? One of the important things is working capital, and actually, you know, we do have one eye on, have we got a purchaser who can get through this deal? And if you've got someone who's promising the world, but you think actually the day afterwards they're not going to be able to fund the business going forwards, then if you're risking deferred consideration, the likelihood is it's not an attractive offer.
Okay, thank you. So thank you both for that. It's really, really interesting, and hopefully some really good takeaway points for the people that are on the call. So now the moment we've all been waiting for, the results of the poll. So hopefully with a little bit of technical moving, there you go. You should all see the results from the poll on our screens. So we've got 5 minutes left, so we'll just take a quick canter through these. So 65%, sorry, of you have either yourselves or clients that are thinking of buying a business out of administration. It'd be interesting to know whether that's as a result of COVID or whether that was going into it as well, that you were on the market and looking. Definitely higher than I thought it would be. Guys, I don't know about you.
Yeah, I mean, and I think, I mean, there will be more, by definition, there's going to be more of these types of processes around, unfortunately, going forward. And I think, as we referenced in the Project Triangle one, that didn't start as an intention of going to administration, but the business got into that situation because, you know, its options were narrowed up. And I think that's what I'm tending to see, that there is an intention to try and do a solvent deal at the start, but ultimately the way to make the acquisition is potentially through a pre-pack or some sort of insolvency procedure.
The second one is, are you confident in undertaking an administration process as well as understanding the risks and opportunities compared to a solvent acquisition? So we obviously have some experienced people attending today. So 59% have bought from an administrator before, 37% unsure, but looking at doing that, unsure how to position yourselves. And hopefully by now and the result of today, you have a better understanding of the process, but do feel free to get in touch if you need any extra support or advice. Thirdly, I think this is the interesting thing for me, is how long we think that businesses will take to get back to a robust level of trading. Definitely an optimistic 1% with 1 to 2 months, but obviously the winning one seems to be longer than 12 months. If you look at Bournemouth Beach yesterday, I think that would beg to differ. But yeah, as regard business,
I think, you know, I suppose what the context of the answers to those questions, we don't know what sector people are envisaging when they're talking about that. I would definitely be, generally speaking, in the probably the 6 to 12 or the longer than 12 months. I think the biggest risk is probably around a second spike and a lockdown. And you know, the reason I say that is because you remind me of the Bournemouth pictures and the fact that there is a feeling that people are very quickly forgetting the rules and going back to what life was like before, and hopefully that's in a sensible way and isn't going to cause a second spike. But there's a question that's just come up. You know, are we seeing an upturn in numbers for admins already? The answer is, we're seeing absolutely an upturn in preparations for admins, in people who are envisaging that they're going to go through a process, which actually probably to some extent leads us on to the fourth question, Max, about historically successful businesses. I don't know to what extent, when people are answering that one, they're envisaging that they're going to be sold through a process, or they're going to be sold with the likes of Ian through a normal share sale. But I think the difficulty is that for a lot of businesses, the problem lies in the fact that they have very quickly accrued a disproportionate level of debt over the last 3 months, and will probably continue to do so over the next 3-6 months.
I think it's just a final comment on that is, you know, the challenge for business owners is, as you say, they've accrued this debt, they've survived through this period. They recognise that there is a challenge over as reopening occurs, and that perhaps is potentially the most risky time, as furlough comes to an end, as cash is used up, as working capital builds. And one conversation that we seem to be having recurringly with clients and people is, you know, it's going to take me 2 or 3 years to get back to the equity value that I have now, because I can see it getting worse before it gets better for me, because I'm going to have to chew through all of this debt. So actually, you know, I was reaching the end of my business life anyway. I might as well consider going through a sale process if I feel that I can get a fair value. And that is the absolute critical point of this. You know, what is fair value, and can that be achieved in the market from the buyer population?
Okay. Thank you, both. So just before we quickly overrun, one final question from Andy. I get loads of emails from a guy selling me a system to buy businesses for £1. Any comments?
It sounds like a great deal. I mean, there are people known in our industry who recognise that businesses are going to, or are likely to, end up in an insolvency scenario, they prey on the fact that shareholders and directors don't want to be the ones dealing with that, and therefore they buy the shares for £1. They then proceed to take whatever value is still in the business and then put it through a process. And, you know, I suppose arguably you look at a scenario such as BHS, where allegedly a lot of money was taken out of the company after it was transferred over. Those types of scenarios do occur. I mean, Ian can have the last word on this, but I'm not sure I would trust in a system that allows you to buy businesses for £1, but you have to pay £2,000 up front, which Andy's just added to his question.
Well, it's all about price and value, isn't it? And you know, the key in buying from administration is to understand what you're buying and what the future costs of that are. And it's more than just what the price you pay on day one. Hopefully we've demonstrated that through the scenarios that we've been through here.
Yeah, thank you. Unfortunately, that's all we've got time for, I'm afraid. But thank you so much to all that have joined us this morning. We hope that you found the webinar useful. Please do look out for our videos and regular insight, exploring resurgence and recovery, which you can find on our website, www.quantuma.com. Please do join us again next Friday at the same time for our next webinar, the details of which will be available after this one. Any questions we didn't have time for this morning, we will follow up directly. Lastly, thank you so much to Simon and Ian for taking the time out of your day this morning to share your expertise and knowledge with us. Thank you to the Quantuma marketing team who've been working feverishly in the background to make sure everything worked and it all went well. Other than that, have a great Friday, have a great weekend, and stay safe, everyone.
Thank you.
Bye-bye.
Bye.